TheoTrade. This is Don Kaufman. December 5th, 2020. Doing the weekend update here on a Saturday morning. Bad news for the economy? Well, apparently that's good news for the markets. We're actually going to start with a little bit of breakdown this weekend on the major index products, including, of course, S&Ps. We'll look at the Nasdaq a little bit. But before I get there, let's talk a little bit about some of the economics behind the backdrop of the marketplace, and that is, the jobs report came out. Buy it! It's horrific, right? The lockdowns, more lockdowns coming. Buy it! One of the things that was a real standout in this marketplace, of course, was the jobs number that was received on Friday morning. Depending upon which economist that you look at, most of them were around, the estimate was supposed to be about 440,000. The actual is about 245,000. So it was a huge miss. It wasn't even as much as a blip on a radar screen here inside of the S&Ps. Nevertheless, again, the lockdowns, you would think, well, they're not necessarily going to have that impact to the marketplace. The marketplace is effectively used to it. And we just continue to kind of grind forward on that. I mean, really, when you start looking at intraday trade yesterday, as I was referencing the jobs number, right here specifically is the jobs number coming out. And we rallied after the cash open after that. And that's why I say, bad news is apparently good news. Maybe the marketplace is anticipating, just immense amounts of stimulus. Speaking of stimulus, which has been, on the forefront of every discussion pretty much day-to-day basis, I like to compare for just a minute, the stimulus that we're seeing right now versus, if you will, like 2008. This is the only, recent, fiscal and monetary stimulus that we have to compare to. And for those of you that do remember in 2008, in October of 2008, Congress actually passed a bill that was a $900 billion bailout, and that was specifically for the banks. And again, I'm not going down a trip down memory lane over here, but that was for the banks. It was a $900 billion bailout, and that actually initiated, if you will, the TARP program. Another $900 billion was added to that just a few months later. The initial $900 billion wasn't going to be enough, but people, that was pretty much over and done with. But there were substantial amount of government bailouts at the exact same time. Firms like AIG, General Motors, where they're actually coming in and buying stock. Nevertheless, if you look at the size of some of the bailouts that they're talking about right now, if we want to call them bailouts, they call them stimulus. Okay, the numbers out of 2008 are absolutely minuscule. There's multiple right now, multiple trillion-dollar programs that are, already enacted, but more on the way. And again, the market absolutely loves it. And as I said, bad news for the economy is good news for the marketplace. The only problem with that is how susceptible is this marketplace to eventually snapping and recognizing that some of this may or may not be good, long term for the marketplace. With that, I'm going to jump in and look at the S&Ps for just a few minutes, because one of the things that I really want to point out inside of the S&Ps is all we're in right now, in terms of the overall marketplace, and that is, again, we're using the S&P futures in this case, as they do trade almost round the clock. This is what I would call no more than a little bit of positive drift in the marketplace. And if you've never heard that terminology has been around forever. But when I say positive drift, I mean, listen, we're all the way back here now, almost a month in time, and we've been boxed in, from about 3,500 to roughly speaking, 3650. Yesterday is a little bit of a breakout to the upside. Yesterday is one of the first days that we actually really did kind of, pop our head out above the range that we've effectively been in. So there is obviously something to this last little spurt, if you will, to the upside, hitting the 3,700 marker. But again, what I was looking at, again, that 30-day 1 hour chart, I think exemplifies this. Now, with that, I think it's also worthwhile taking a quick glance at the Nasdaq, because again, with the Nasdaq, everybody's like, well, the Nasdaq, what did it do? The exact same thing. All right, this is still a relatively tight range for the Nasdaq, and the Nasdaq did literally absolutely nothing for weeks on end. A little bit of positive drift, obviously, hitting this index product as well. And last but definitely not least, and I think this is one where you got to pay attention, is the Russell. And I'm going to show you the Russell in the exact same time frame. This is that spike up, if you will. Okay, here, people. This is a magnificent range inside of the Russell. So I wanted to start with that because everybody's, I guess drooling over themselves. The marketplace has had this, immense move, if you will, to the upside, and that is spotty because again, the S&Ps really, in the most recent 3 to 4 weeks have had just this drifting, if you will. It's also kind of exemplified when you start looking at the SPX. Okay, and specifically the expected moves. For the most part, seeing a lot of moves that are inside the expectations. There, we'll come back to that though a little bit later over here. One of the real standouts as well, with what I would term this like positive drift. And again, don't worry about any of the lines in the chart. What I wanted to show you here inside of the S&Ps is just how incredibly low, okay, the volume happens to be. So you get this bad news, and you get these spikes of volume when some of the data gets released, like the jobs number. Again, even the jobs number, though, all right, we only saw some 6,000 contracts, which is incredibly light. But on a much more historic level, right, the volume inside of the S&P futures, all right, you got to recognize, we didn't even do 1 million contracts yesterday, which is not just light, it's absolutely unequivocally dead. Compare this, all right, to any of the recent trade. And again, I want to highlight and emphasize this because if you want to really know, the underbelly of the beast, okay, this is exactly where the volume was. This is actually one of the lightest volume days that we've seen, okay, really in recent history. In a full trading session, it's one of the lightest volume days that we've seen was Friday. And that is, again, it's a little bit almost awe-inspiring to see 1 million contracts trade with the marketplace, though, still capable of moving. And this is the exact point that I want to make. The S&Ps, doesn't matter. They still moved up 25. Okay, it's a low liquidity mess. And that's exactly what we're going to explain here because the liquidity concentrations continue to grow. And this is a point that I was making in the last couple of weeks, specifically on the weekend updates. Let's say the liquidity concentrations, the options order flow, okay, is actually moving several stocks, and those stocks are capable of moving the entire marketplace. Now, I'll just give you a quick example. One of the ones that's been moving specifically the marketplace in general happens to be, of course, Tesla. Tesla has a large enough market capitalization right now where, although it's not yet fully included inside of the S&P 500, it is still moving the S&P 500. It is absolutely moving the Nasdaq. And when you start to look at this, though, some of this kind of faded a little bit in yesterday's trade. Even Tesla only traded about 60% of its normal daily option volume specifically yesterday, and I wanted to point that out. But there's other stocks, and these are not as pivotal, if you will. There's other stocks that you're seeing, okay, concentrations of liquidity, almost like a coordinated effort, if you will. Look at like GE, totally off your radar screen, right? Well, it's not off everybody's radar screen. Some 300,000 calls traded in there. Okay, then we'll actually look at something like Moo. I'll talk about Moo also in a little few minutes from now. Micron, this is one I've actually had positions on. Huge number of call options actually driving stock higher. Okay, take a look, for example, at something like Caterpillar. Caterpillar's completely off everybody's like radar screen. Yeah, until yesterday when there was this breakout number. This is a huge number of options trading in Caterpillar. Caterpillar is on the peripheral. Like, this thing just doesn't trade a lot of action out there. All of a sudden it does 2.5 times its normal daily option flow, specifically because, well, it's going to break out to the upside. And again, these are underlyings that are having influence, if you will, back to the broader S&Ps. But I just wanted to detail that because, again, it is, without unequivocation, it is the stocks, okay, that are not moving the marketplace, and it is the option marketplace that's actually driving the stock, okay, and many of those cases. Now, something like Caterpillar, it's decent size. That's not exactly going to move the S&Ps. GE is not exactly going to move the S&Ps. But when you start doing that in, for instance, like things like financial products, okay, you absolutely are going to move the markets. And that's something we're also going to come to here in a moment. We start to look at a couple of index products out there and some of the sectors themselves. So with that, liquidity concentrations, okay, this is something to watch. It's also something to trade, because you'll notice that, well, apparently nobody's trading right now inside of the S&Ps, and that's one of the points that I wanted to make with the low volume. Nobody's doing anything in here. This thing did absolutely nothing yesterday. I mean, you've got minutes in here, and you know what? I don't just want to detail Friday and say, oh, Friday was a little bit of an outlier. Okay, there are minutes going through inside of the S&Ps where they traded, like, here's a minute, traded 278 contracts in that particular minute. Okay, listen, go back, do some research in here. All right, yourself, go back and, go back like 5 days, go back 10 days, okay, and see what you got. There is no trade. Again, no trade inside of the S&Ps throughout the course of the trading session. Here's, 300 and some odd contracts, 363 contracts trading in 1 minute inside of the S&Ps. And at the exact same time, there's more capital and liquidity and order flow being jammed into something like Tesla at the same time, which, again, when the notional value is bigger in individual stocks, you got yourself a little bit of a problem there. Okay, I mean, think about how it's the point of me saying this is it's about vulnerability of the marketplace. And I want to emphasize that because that's why I'm bringing this up. Bad news for the economy is good news for the markets, right? All the lockdowns, everything in here is just check, check, check. If you're looking for a vulnerable marketplace, you have one right now. Okay, and with all of that, okay, now we have to talk a little bit about bonds because all of a sudden, out of nowhere, bonds, okay, this is where the professionals are. They're the professionals in this business, okay, are reacting to order flow. The market making firms are reacting to order flow in products like Tesla. And when I say reacting to order flow, you buy calls, they sell you calls, and they turn around and buy stock, yada, yada, yada. That goes on and on and on. But here, this is real positioning. Okay, this is actually quite the contrary. Some of the biggest order flow that we've seen in recent history is going on inside of the bonds. Okay, and when I say some of the biggest order flow, I mean take a look at the volume. Because this is something that's off, the beaten path. Not everybody necessarily is keyed into bonds. But if you look back in, really since the onset of the Corona kind of crisis and crash, and I'm going to go ahead and zoom out for a second and open up a full year chart. I just want to display something that I find very, very interesting. So the onset of the coronavirus. Okay, the onset of the coronavirus is right here in this neighborhood. You can see the big spikes in volume, but the Fed came in and just squashed everybody. I mean, the Fed literally came in right over here. They squashed everybody. Okay, and again, I'm looking at the volume. The volume has almost doubled. Almost doubled. We're doing like 400,000 contracts a day. That's some big volume. Again, over here is a roll. I wouldn't worry about that. That's a roll. This is a roll. Okay, but net, the volume has almost doubled inside of the bond product, and the bonds are starting to see some pretty vicious sell side activity, which is steepening the curve. And if you're not into bonds, you can look, of course, at the notes. The notes is the exact same thing. Look at this. Okay, this is where you think the Fed has control, and all of a sudden, now the bond markets have control. Okay, the bond markets are large. They are in control right now. And if you ask where professional trade has shifted to, okay, they're back in the bonds, and they're back in the bonds in a very, very big way. And again, when you talk about vulnerabilities of a marketplace, take a look how much the interest rates have actually moved. This ain't positive drift. Okay, this is a very serious move to the upside in interest rates. So we now have, and again, this is the TNX. For those of you unfamiliar with this product, the TNX is the 10-year. Okay, and this is to be read, and I don't want to confuse anybody, but this is to be read is we are climbing and almost at 1%. So 1% on the 10-year. And when I said that this is a lot more than positive drift, you look back to October to right now. I mean, this is like 0.6%, almost to 1%. That's a huge move. I mean, the 10-year is that's absolutely flying. And I think sometimes to look at interest rates, it doesn't look like much on a chart. You look at it on a percentage basis, though. On a year-to-date basis, well, it was down here 66%. Now it's only down again 48%. These are huge moves in a very, very short time in interest rates, which is in very large part why. Again, this is why products like the XLF, are performing incredible right now. Ooh, with the rising interest rates comes, of course, the financials. They love it. But the problem with this notion is that it works really, really well until the interest rates kind of take off to the upside. Interest rates take off to the upside. It'll stall out everything. It'll stall out the economy. It'll stall out the financials. Nobody wants to borrow the moment those interest rates pick up. And that 1%, and this is the reason I'm bringing this up, this 1% inside the TNX, believe me, that's going to be a big threshold. I mean, we're a hop, skip, and a jump away from a 1% 10-year, and you think, it's nothing, it's like 1%. I would agree with you. Nevertheless, that can actually stall out everything in this marketplace. So this is a very fine line. So again, when you're talking about, a marketplace and you're looking at all these vulnerabilities, one of the things that people are not necessarily are looking at are that the bonds all of a sudden are center stage. And they have been center stage. They haven't done anything. Like the bond market hasn't done anything, okay, since the Fed stepped in, okay, after the onset of Corona. I mean, everybody was like, paralyzed because what the Fed did. They came in there and just, guns loaded, started firing into the marketplace, everything they had. Well, now they're actually allowing the bonds to sell off a little bit. And those bonds selling off, I mean, there is the notion that the bonds could start to sell off and the S&Ps could start to sell off with those. Nevertheless, okay, what you have is there's continued sell side activity in here that is going to cause a little bit of panic as the interest rates start to fly higher. So we're going to look very, very carefully, very specifically, okay, if you start to break under the 170 handle, in the bonds, start to really pay attention because this trade could become very, very dicey, people. All right, with that, that's why I say bonds, rates too far, too fast. Now we're actually going to talk a little bit about what's working and what's not in the overall market strategy-wise, okay? So a little bit of a strategy session here. Then I'm going to talk about a few stocks. Do I want to be long? There's always this assumption. I carry a lot of short positions, okay? And I am short a lot of stuff, but I'm also long. Okay, a couple of products over here. Yes, I'm willing to admit that I'm long GE, and I'm going to be questioning my own trades. Like, do I still want to be long these products after the moves that we've seen? So let's get into it. Like, what's working and what's not. All right, so Moo. This is over and done with, okay? This is actually a big gamma squeeze that I caught on to. I'm out. I'm out of the contest. In fact, okay, I like to delineate that I got out here the day prior to this wicked move to the upside. So, here we are again, on December 5th, but, or sorry, I should say, yeah, December 5th, but I actually got out specifically on the 3rd as this above 70. I'm not going to make much more. I was actually using an out of the money spread. The reason that I'm bringing up Micron is it's the strategy that I used in here. Okay. And to strategize this for you, I went out and bought, and I'm going to open up the option chain here, and I'm going to open up a few more strikes because of what's working and what's not. I think this is important, okay? I went out and actually bought an out-of-the-money spread. I bought like a $5 wide spread, okay, way out of the money and let the market actually move to me. And this was not about trying to make like 55 or 65%. This is about making like 200, 300%. And many of you did and followed along in this particular trade. So one of the things that we learned from Micron, it had nothing to do with being bullish or bearish, that buying a far out of the money spread was probably the most effective trade in there. It absolutely would have smoked the returns of just buying a call. And a lot of people like to buy calls, but this was a nice setup for a trade. Okay. The next one on the docket here, Tesla. Okay, because I've talked about Tesla a lot. In fact, I even did a video earlier this week about Tesla. Okay, so in Tesla, I am still carrying a position. The position that I want to elaborate upon, I had sold the 950 calls and sold those naked. Those calls, I now bought them back. So I bought back the 950 calls. I sold the 950 calls for $3.90. I bought them back, okay? And I took that credit where I sold the calls and actually bought this $15 wide put spread. So basically what I'm in right now is a $15 wide put spread, and I paid roughly 60 cents for it because I had sold the calls to finance the cost of this put spread. So net, what do I have at risk? Oh, 60, 70 cents, including all the transaction costs and everything. Between 60 and 70 cents is my max risk, but I have 13 days. If Tesla actually collapses, okay, below 500 in the next 13 days, this thing is going to be an absolute home run. Close that one up for just a second. Next in the docket here, we actually bring up Intel. Okay, in terms of Intel, this one, okay, this is not working for me. So I actually took a short position, looking for this thing to roll over. Okay, my inclination, this was a pop, and that this was going to roll over. It's not working, but I want to bring something into scope over here. Okay, I had a short term in out spread. Right, and this is a trade that you can see it right here. It's done. It's over. There's no salvage value. But at the exact same time, I also want to reiterate something. Okay, I am carrying a long duration, again, a long duration position in here, and I had closed, all right, most of my long duration position back here at the 45 level. I left some of it on, thinking we were going to continue to break down, but now I've actually re-upped in a portion of that position. So that is, I am long duration, short Intel right here at the 52 level. And the inception of this trade, again, the inception of this trade, I anteed up a little bit yesterday, specifically on, again, long duration. These are deep in the money puts, synthetic short stock position, 76 days out, onward and upward from there. Goldman Sachs, okay? Make Goldman Sachs really, really easy. Goldman Sachs, we've had a lot of P&L in here generated specifically from gamma iron condors. These are buy-side iron condors. So what did I do? Did it again. This is a trade that we've already done 2-3 times in a row. And we did it in October. We did it in November. We're doing it again in December. Okay, it's buy-side iron condor, over and done with here. That trade is, when I say over and done with, we've already had 2 profitable. So I always go back to the well. Do more of what works and less of what doesn't work. Okay, next in the docket over here. Okay, Microsoft, I also had a gamma iron condor in here. I'm out. I am out of the gamma iron condor inside of Microsoft. This thing has done absolutely nothing and not a profitable trade, okay? Intel, Microsoft, not so good. Moo, Tesla, Goldman Sachs, working great. Last on this list over here is Caterpillar. Okay, Caterpillar, this was a gamma iron condor. This is a buy-side iron condor. Caterpillar absolutely smoked to the upside. It was a home run in terms, again, it was a home run in terms of the gamma iron condor. Here's also one that I am carrying. I am carrying a longer duration short position in, and this breakout to the upside, okay, for those of you, if you're looking for a short position, you got to be looking for short position. You got to be looking to take a little bit of heat. Anywhere up here at like 185. This is all-time high inside of Caterpillar, which is shocking because this actually goes back. And it's one of the things I wanted to mention. Bad news for the economy is good news for the marketplace. Okay, if you had told me that Caterpillar would be trading at an all-time high earlier this year, I probably would have laughed at you. It is absolutely at an all-time high right now with economic wins in its face, people. This one's pretty shocking to me. Nevertheless, we made some decent money here on a gamma iron condor, and we'll look for other opportunities inside of Caterpillar in the very near term. So I wanted to take take what's good with the bad there in Caterpillar is that, yes, the gamma iron condor is making money, but I also have a short position in here that is, that's hurting a little bit. All right, the next thing I wanted to question here, I'm kind of wrapping some of this up. All right, IWM. I'm long in IWM. Okay, I am still maintaining a long position in IWM. I don't mind saying it, okay, but I am questioning myself here in IWM. Again, in IWM, I'm still long, but I've actually pared back the position to 300 shares, okay? Effectively, what am I saying in here? Yeah, I'm long, but I'm getting nervous over here. But I've pared back the size of my position. I've pared back the size of my position to 300 shares. The next one on the docket, XLE. Okay, I am long inside of the XLE, but I am allowing the stock to be called away. I am down to almost nothing in the XLE. I will be out of this. I have a deep in the money call sold against the position. I'm going to allow the stock to actually get called away. The next one on the docket, MJ. I am long MJ, and I've actually also allowed some of this to be called away, but I'm going to go ahead and sustain the remaining 600 shares inside of MJ. For those of you not familiar with this, it's the marijuana ETF. This thing has just been on a tear, okay? An absolute tear to the upside. I would not purchase it here, okay? No way, no shape, no form. I've already allowed some of the stock to get called away, having sold calls against it. Nevertheless, I'm going to maintain a small position in here. Next in the docket, XOP. So XOP is right there with the XLE. This has had a blistering move from the 40 handle to the 60 handle. I am also, again, net long in here. I'm going to allow some of this position to persist for a period of time. Again, it's a very, very minute position. Ford, okay. Anything anywhere near the $10 range, and I am out here. I am already selling calls against this at the 9 handle, but some of those will be rolled out. But again, Ford hits the 10 handle, and I am over and done with. Similarly, inside of GE, okay, at the 11 handle, and I am going to go ahead and exit the remainder of my position in here. So what I'm pointing out in many cases here is people ask about the longs that I'm in, okay, and I'm telling you right now, I'm getting out of some of the longs that I'm in. It's just these have moved too far too fast. And you say what you will about the marketplace, say what you will, again, about the economic backdrop and all the stimulus over there. And quite frankly, okay, that's fine. You can say what you will, but when a stock moves up 100% or almost 100% in a matter of a few weeks, I mean, people, these are just not healthy moves, okay? And I'm long, and I'm telling you, I don't feel it's a healthy move, and I want out of my delta risk in the GE, in my Ford, okay? My XLE is over and done with, and IWM is just shocking. It's a major index product that has just come on and just flown, so I am paring back the position in there. Last but not least, we're actually going to cover a little bit about the SPX, the expected move. We are a hop, skip, and a jump away, okay, from the edge of the expected move. Remember, on Wednesday, I did, our nightly update here, and I said, like, hey, we've done squat this week, and look for a move, okay? I got to tell you, I'm pretty shocked that the move came to the upside over here. Throughout the course of this week, I was looking for the economic news to finally break the back of the marketplace, and it didn't do so. Okay, again, bad economics, good for the marketplace, but we're a hop, skip, and a jump. We were only about 9 points. We're about 9 points away from the edge of the expected move. What do we expect next week? I find this one kind of interesting because last week had a $70 expected move. The market's actually just grinding a little higher. This next week, we're looking at about a 64.56, and that expected move, you would have thought, based on nothing happening this week, that the expected move would have contracted. It's not. Okay, tells us something about the marketplace, and I'll leave you with this final thought. The marketplace as a whole right now, it's kind of pricing a floor into volatility. The VIX, okay, probably has a floor in place. We'll just put it at a big round number, about 20, because the volatility didn't really subside. Even after we had a dead week in the marketplace, this past week being the dead week, the volatility didn't really subside. 5 points inside of the SPX expected move is absolutely nothing. With that, I will, again, reiterate, bad news for the economy, good news for the marketplace. Again, I think we have a situation that'll likely come to a head here even before the holiday season kind of hits. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.